If you had put $10,000 into the right stock 5 years ago, you could be sitting on nearly $200,000 today. That's not a hypothetical. That already happened. And I'm about to show you my actual portfolio. The actual stocks I own right now, the actual dollar amounts, and exactly why I think we are in the middle of the biggest wealth building window most of us will ever see. Not next year, right now. Stay with me, because stock number 4 on this list is up over 100% in the last 12 months, and I think it still has room to run. And stock number 1 is one almost nobody is talking about yet. So let's stop wasting time. Let's open up the portfolio. Recession 1, the framework. Before I show you a single ticker, I want you to understand how I pick stocks, because the how matters more than the what. Anyone can hand you a list of tickers. What actually makes money is understanding why a company sits where it sits in an industry, and what happens 2 or 3 steps downstream from the obvious trend everyone else is chasing. That's the mental model I use, looking for second-order effects. Everyone can see the first-order effect. AI is booming, so buy the chip company. Everyone already knows that. The real edge is asking, okay, if that's true, what does that force to happen next? Who benefits from the consequences of the consequences? That's where the market hasn't caught up yet, and that's where the money is made. I also only invest heavily in sectors that fall inside my circle of competence. The parts of the market I actually understand deeply because of my background. Everything else I keep in simple index funds. You don't need to be an expert in everything. You need to be dangerous in 1 or 2 areas and humble about the rest. With that out of the way, let's get into the actual picks, starting with the one I think is the most misunderstood stock in the entire AI trade right now. Section 2, pick number 1, the Highway stock. This company's stock dropped hard this year, down more than 25% at one point, even after posting record revenue. That kind of disconnect is exactly the kind of opportunity I look for, because it usually means the market is reacting to short-term noise while ignoring the long-term structural story. Here's the setup. Hundreds of billions of dollars are being funneled into AI infrastructure this year alone. That spending has already made obvious winners. The company making the chips, the company making the memory. Those trades are known, everyone's already piled in. But here's the second order effect almost nobody is pricing in. All of that AI activity doesn't just need chips and memory, it needs to move data. Every AI agent, every model inference, every request bouncing between a data center and a user is traffic across a network. We've already seen storage prices climb as demand for capacity spikes. We have not yet seen the same repricing happen for the infrastructure that actually moves that data around the internet. This company sits right in the middle of that highway. It's often described as running a huge share of the traffic on the modern web. And as AI agents multiply, not just chatbots, but autonomous systems constantly calling APIs, scraping, querying, the sheer volume of network traffic explodes. Revenue growth here has been running above 30% a year. Profitability is still thin because the company is reinvesting aggressively into growth, but that's a choice, not a weakness. And if even a small amount of that AI spending translates into better margins on existing infrastructure, the earnings leverage could be enormous. There's a second reason I like this one. AI crawlers are quietly breaking the economic model that funds the entire free internet. Sites get scraped for training data or real-time answers without getting paid or getting the ad views they depend on. Whoever solves that problem sits at a massive choke point of the internet's future economy. This company has more leverage over that fight than its market cap suggests, which is exactly the kind of asymmetry I want in a position. This is a long-term hold for me, not a trade, but my next pick is a very different animal, higher risk, and potentially a much shorter runway. Before we get to pick number 2, quick word from today's sponsor, POV. the platform I actually use to track and manage this exact portfolio. If you're newer to investing, their education tools make it easy to actually understand what you're buying instead of just guessing. If you're more advanced, the customizable dashboard lets you build a workspace that actually matches how you think about the market. No unnecessary trading restrictions, competitive margin rates, solid interest on uninvested cash. Basically, the tools a professional desk would use built for a normal person. If you sign up using the link in the description, there's a limited time welcome offer running right now. Links below. Using it genuinely helps support videos like this one, so thank you if you check it out. Okay, back to the stocks. Section 3, pick number 2, the bottleneck stock. This next stock is up well over 100% this year, and I know that scares some people off immediately. Isn't it too late? I don't think so, and here's why. The AI trade started with compute. Everyone wanted GPUs, but GPUs alone don't do anything without data flowing in and out of them fast enough. That data movement has become the actual bottleneck holding back the next leg of AI performance. The companies that make the high-speed memory sitting right next to those chips have suddenly gained enormous pricing power because there is more demand for their product than there is supply, full stop. When I looked into whether this stock had already run too far, I checked 3 things: the forward valuation, the growth trajectory, and management's own confidence in the business. On a forward basis, the valuation isn't as stretched as the trailing numbers make it look, because revenue and margins are both expanding so quickly that the multiple compresses fast if the growth holds. The real question isn't, is this expensive? It's, does this growth rate survive the next 12 months? Because if AI infrastructure spending merely slows down instead of collapsing, this business still prints enormous cash flow. One signal I pay close attention to: dividend policy. When a management team raises a dividend meaningfully, they are making a public bet on their own future cash flow. Because you don't hand shareholders more cash if you're privately worried the well is about to run dry. That kind of action tends to say more than any slide deck. There's also a labor story here worth knowing, because it tells you how strong the economics really are. When margins get this good, companies start using compensation as a competitive weapon, paying employees a meaningful share of profits to keep talent from walking to a competitor. That kind of bidding war for skilled workers is a very reliable tell that an industry is in a genuine supply crunch, not a hype cycle. The risk to understand here is contract structure. Some of this growth is locked in through long-term agreements, and some is running through shorter, more flexible deals that are easier to sign quickly, but also easier to walk away from if the buyer's own spending slows down. That's the lever I'm watching. If those shorter-term deals start getting pulled instead of renewed, that's my signal to reassess, not before. Section 4, pick number 3, the 15-year hold. Now let's leave the infrastructure trade entirely and go somewhere the market hasn't fully priced in yet: energy. Every AI data center needs power, and I mean an almost unbelievable amount of it, concentrated in a very small physical footprint. We don't have infinite cheap energy sitting around waiting to be tapped. That is a real physical bottleneck, and bottlenecks, as I said earlier, are exactly where I like to look for opportunity. Zoom out and look at how the US has generated power over the last 150 years. It moves in long cycles: wood, then coal, then oil and gas. And now we're at the start of another shift toward nuclear and renewables. My pick here sits at the center of that shift: a major nuclear operator that has also expanded aggressively into natural gas, giving it dominance across both the near-term bridge fuel and the long-term power source. Here's why this matters for AI specifically. Big tech companies have already started signing direct power deals, reactivating shut-down nuclear plants, funding new reactors, locking in supply for their own data centers because they know the public grid alone can't handle the load. That is real capital being committed to nuclear right now by the same companies spending hundreds of billions on AI. The obvious pushback is public fear of nuclear power. That fear is understandable historically, but it doesn't match the actual safety data. Nuclear is one of the safest sources of energy that exists per unit of power generated, safer than wind, dramatically safer than oil or coal. When I see a gap that wide between perception and reality, I don't see a reason to stay away. I see a market that hasn't caught up yet, which is usually where the best long-term entries exist. As public sentiment slowly re-rates toward reality, capital tends to follow. I'm not expecting a fast payoff here. This is the kind of position I could be holding 15 years from now, collecting dividends the whole way. Section 5, the diversified play. If you like the nuclear thesis but don't want single stock risk, there's a simpler way in: a nuclear and uranium-focused ETF. It gives you a basket of exposure across reactor operators, uranium miners, and equipment makers instead of betting everything on one company's execution. The expense ratio runs higher than a typical index fund, but it's still reasonable given how thin the good options are in this specific niche. Just be aware, some of these funds aren't US domiciled, so double check that your brokerage actually gives you access before you go looking for it. Closing, strong CTA. So that's the real portfolio, real positions, real thinking behind every one of them. Not stock tips pulled out of nowhere. A framework you can actually reuse on the next trend, whatever it ends up being. If this kind of breakdown is useful to you, the best thing you can do is hit subscribe, because I'm going to keep doing exactly this. Full transparency, real numbers, no hype for hype's sake. Drop a comment telling me which of these 4 you'd add to your own portfolio first, and I'll pin the best replies. I'll see you in the next one.